Most Americans think taxes come from Congress, from loud debates, televised votes, and last-minute deals in Washington. But one of the most effective taxes in America doesn't come from Capitol Hill at all. It comes quietly, once a year, in a short IRS notice that almost no one reads. If you drive for work, if you're a contractor, a small business owner, an Uber or DoorDash driver, or even someone who uses their car occasionally for business, you're paying this tax every single mile, and you probably don't even realize it. It's called the IRS Mileage Rate, and in 2026 it tells a story far bigger than a few cents per mile. Imagine driving 20,000 miles in a year, trusting that the government's number fairly covers your fuel, your repairs, your insurance, and the slow death of your car's value. Now imagine that number is always just a little too low. Not enough to cause outrage, not enough to make headlines, but enough to quietly shift billions of dollars away from working Americans and back into the system. That gap, small, boring, and invisible, is where the real story begins. Because when inflation rises faster than the mileage rate, the difference doesn't disappear. Someone pays it. And that someone is you. The reason IRS Mileage Rate 2026 is suddenly trending isn't because Americans are obsessed with tax forms. It's because people can feel in their daily lives that something doesn't add up anymore. Gas prices jump overnight. Insurance premiums explode without warning. Car repairs cost more every single year. Yet the reimbursement number meant to protect drivers always seems to trail behind reality. This video is not about how to calculate deductions or how to file your taxes. This is about understanding why the system is designed this way in the first place. The IRS mileage rate was never meant to make you whole. It was designed for simplicity, for control, and most importantly, for predictability in government revenue. When you zoom out and look at its history, a pattern emerges. During inflationary periods, the rate lags. During economic stress, adjustments come late and cautiously. And that lag functions like a silent tax one that doesn't require a vote, doesn't trigger protests, and doesn't show up as a line item on your paycheck. By the end of this video, you're not just going to understand what the IRS mileage rate for 2026 might be. You're going to understand why modern governments prefer hidden mechanisms over visible taxes, why millions of Americans feel poorer despite adjustments, and how one small number per mile reveals the true relationship between inflation, debt, and power in the American money system. This is Money Historian, and today we're exposing the tax America doesn't realize it's paying. To understand why the IRS mileage rate matters so much, we first need to strip away what most people think it is. On the surface, the mileage rate looks like a neutral, even generous number. A simple calculation meant to fairly reimburse drivers for the cost of using their own vehicle for work. Fuel, maintenance, insurance, depreciation all wrapped into a clean per-mile figure. No receipts, no spreadsheets. Just multiply and move on. But that simplicity is deceptive, because the mileage rate is not a reimbursement of your real costs. It is an average, based on national assumptions, historical data, and bureaucratic caution. It does not know whether you live in California or Kansas. It does not care if your insurance doubled this year or if your car repair bill wiped out a month of income. The rate assumes a hypothetical average driver driving an average vehicle under average conditions. And the moment inflation accelerates, that average becomes a financial trap. When your real costs rise faster than the rate, the difference does not vanish. It becomes an unreimbursed expense. Multiply that gap by millions of drivers and billions of miles, and you're no longer talking about a rounding error. You're talking about a silent transfer of wealth. A system that appears neutral on paper, but consistently shifts the burden downward. This is why the mileage rate isn't just a number, it's a pressure valve. And it only works if people don't question it. This wasn't always controversial because inflation wasn't always volatile. To understand how we got here, you have to go back to the origins of the mileage rate itself. The concept emerged in post-war America, during a time when the federal government was expanding rapidly and needed standardized systems to manage a growing economy. The mileage rate wasn't designed to protect workers, it was designed to simplify administration. Tracking individual vehicle expenses was messy, inefficient, and politically risky, so the IRS chose a flat rate. One number, easy to enforce, easy to audit, easy to adjust slowly. Over time, this rate survived oil shocks, recessions, and financial crises. And if you chart its history, a pattern becomes impossible to ignore. During inflationary spikes, the 1970s oil crisis, the aftermath of 2008, and especially post-2020, the mileage rate always lags, sometimes by months, sometimes by years. The adjustment is reactive, never proactive. That delay matters, because inflation doesn't pause while committees deliberate. Costs hit drivers immediately. Gas jumps today. Insurance renewals reset tomorrow. Repairs reflect current prices, not last year's averages. The IRS, meanwhile, adjusts cautiously because every cent increase represents billions in forgone tax revenue. So the system quietly absorbs inflation by letting individuals carry the burden first. That's not a bug. That's the design. Now bring this history forward to the present moment, and the picture becomes even clearer. As we approach 2026, Americans are dealing with a reality where vehicle ownership is more expensive than at any point in modern history. Fuel prices swing unpredictably. Insurance premiums are climbing at double-digit rates. Car prices, new and used, remain historically elevated, which means depreciation is brutal. A car that costs more to buy also costs more to lose value on. Repairs are no longer minor inconveniences. They're financial events. A single transmission issue can erase weeks of income. And yet, the mileage rate treats these realities as statistical noise. It smooths them out. It averages them away. A 1 or 2 cent difference per mile doesn't sound like much until you do the math. 20,000 business miles at a 2-cent shortfall is $400 for one driver. Multiply that across gig workers, contractors, delivery drivers, and small business owners, and you're talking about billions in unreimbursed costs. That money doesn't go to fixing roads. It doesn't go to healthcare. It simply reduces deductions. And reduced deductions mean higher effective taxation. Not by raising rates, but by shrinking relief. This is why calling it a hidden tax is an rhetorical exaggeration. It's accounting reality. So who actually pays this tax? Not corporations with fleets and accountants. Not large firms that negotiate reimbursements internally. The burden falls disproportionately on individuals who rely on their vehicles to survive. Gig workers who drive because they have no alternative. Rural Americans who commute long distances because housing is cheaper far from city centers. Independent contractors who trade job security for flexibility. These groups don't receive mileage checks. They receive deductions. And deductions only matter if they reflect reality. When they don't, the cost shows up quietly in lower savings, higher debt, deferred maintenance, and financial stress. What makes this system so effective is that it never sends you a bill. There's no envelope labeled mileage tax. There's no deadline to protest. You feel it slowly, indirectly, through tighter margins and harder trade-offs. And because everyone experiences it individually, there's no collective outrage. No coordinated resistance. Just millions of people wondering why they're working harder for less. At this point, the obvious question is why the government allows this gap to persist. The answer lies in political economics. Visible taxes are expensive politically. They require votes, debates, and accountability. Hidden mechanisms, on the other hand, operate quietly. Adjusting a mileage rate is framed as a technical update, not a fiscal decision. It doesn't dominate news cycles. It doesn't provoke backlash. And it allows the state to manage inflationary pressures without explicitly raising taxes. By letting deductions lag behind real costs, the government preserves revenue in an inflationary environment. This is especially important in an era of massive deficits and rising debt servicing costs. Every dollar not deducted is a dollar taxed. Every delayed adjustment is temporary relief for the Treasury. And because the system is framed as assistance, not extraction, most people never challenge it. Behavioral economics plays a role here. People feel compensated, not taxed. They see a number go up even if it doesn't go up enough. And that psychological framing matters more than the math. When you zoom out far enough, the IRS mileage rate becomes a case study in how modern states manage economic stress. Instead of dramatic policy shifts, they rely on subtle levers. Indexing delays, averaging formulas, technical adjustments that shape outcomes without drawing attention. This isn't unique to mileage rates. You see it in tax brackets, benefit thresholds, and inflation adjustments across the system. The mileage rate just happens to be one of the clearest examples because it touches everyday life so directly. Every mile becomes a reminder that systems don't exist to maximize fairness, they exist to preserve stability. And stability, from the perspective of the state, often means protecting revenue first and adjusting citizens second. So when you hear IRS Mileage Rate 2026, don't think of it as a helpful update for drivers. Think of it as a signal of how inflation is being absorbed, a signal of who is expected to carry the weight, a signal of how quietly value can be extracted without resistance. The most powerful taxes are not the ones debated on television. They are the ones embedded in formulas, delayed by design, and normalized through repetition. And once you see that, you can never unsee it. Because the next time you calculate your mileage deduction, you won't just see a number. You'll see a system working exactly as intended. If there's one thing this story should leave you with, it's this: the most powerful forces in modern finance don't announce themselves. They don't come with speeches, protests, or breaking news banners. They arrive quietly, wrapped in technical language, hidden inside formulas that look neutral and harmless. The IRS mileage rate is one of those mechanisms. It isn't designed to punish, but it isn't designed to protect either. It exists to keep the system stable, predictable, and solvent, especially during periods of inflation and debt pressure. And when stability for the system conflicts with fairness for individuals, the system almost always wins. Every mile you drive under an underadjusted rate is a reminder that modern taxation isn't just about what the government takes openly. It's also about what it quietly stops giving back. This is how value is extracted without resistance, how inflation is absorbed without votes, and how millions of people feel poorer without ever seeing a bill. Once you understand this, you start to notice it everywhere, not just in mileage rates, but in tax brackets, benefit thresholds, and every place where numbers lag reality by just enough to matter. If this video changed the way you see money, inflation, or the systems behind everyday life, take a moment to support the channel. Like the video, it helps more than you think. Subscribe to Money Historian if you want deeper stories about how power, debt, and finance really work beneath the surface. And tell me in the comments, do you track every mile carefully, or did you trust that the system was fair? Your answer says a lot about how invisible these mechanisms really are. In the next video, we're re-uncovering another adjustment hiding in plain sight one that affects far more people than they realize. Stay curious, stay skeptical, and I'll see you in the next chapter of financial history.